Dividends, stock splits, and share repurchases are important corporate actions that influence shareholder value, stock prices, and capital structure decisions. The program explains that companies distribute cash to shareholders primarily through dividends and share repurchases, while stock splits adjust the number of shares outstanding without changing total company value. These actions provide insight into management's expectations regarding profitability, growth opportunities, and financial flexibility. Analysts evaluate corporate distribution policies carefully because they affect investor returns, taxation, liquidity, and market perception. Understanding dividends, splits, and repurchases is essential for investment analysis, valuation, and portfolio management because these actions influence both shareholder wealth and corporate financing strategy. Dividends are cash or stock payments distributed by corporations to shareholders as a return on invested capital. Cash dividends are the most common form and are usually paid quarterly, although some companies distribute dividends annually or semi-annually. The program explains that dividend payments often signal management confidence in future earnings stability and cash flow generation. Companies with consistent dividend policies are generally viewed as financially mature and stable. However, paying excessive dividends may limit reinvestment opportunities and future growth potential. Analysts therefore examine payout ratios, dividend growth trends, and cash flow coverage carefully to determine whether dividend policies are sustainable under changing business and economic conditions affecting profitability and liquidity. The dividend payment process involves several important dates, including the declaration date, ex-dividend date, record date, and payment date. The ex-dividend date is especially important because investors purchasing shares on or after that date are not entitled to receive the upcoming dividend payment. Stock prices often decline approximately by the dividend amount on the ex-dividend date because part of the company's cash assets is transferred to shareholders. The program emphasizes that dividends do not create value directly because company assets decrease by the amount distributed. Instead, dividend policy affects shareholder wealth primarily through signaling effects, investor preferences, tax considerations, and the balance between retained earnings and shareholder distributions. Stock splits increase the number of shares outstanding while proportionally reducing the share price, leaving total shareholder value unchanged. For example, in a 2-for-1 split, shareholders receive 2 shares for each original share, while the stock price adjusts to approximately half its previous level. The program explains that companies often implement stock splits to maintain share prices within ranges viewed as attractive or affordable to investors. Stock splits may improve trading liquidity and broaden investor participation, although they do not change the company's underlying economic value. Analysts interpret stock splits as potential signals of management optimism regarding future growth, profitability, and continued positive stock performance. Share repurchases occur when companies buy back their own shares from the market, reducing the number of shares outstanding. Repurchases may increase earnings per share because profits are divided among fewer shares, and they can provide tax advantages compared with dividends in some jurisdictions. The program notes that repurchases offer greater flexibility because companies can adjust repurchase programs more easily than dividend policies. Analysts evaluate repurchases carefully because they may signal management belief that shares are undervalued. However, repurchases financed through excessive borrowing may increase financial risk and weaken long-term financial flexibility. Understanding the motivation and funding behind repurchase programs is therefore essential for accurate financial analysis and valuation. A strong understanding of dividends, stock splits, and repurchases is essential for evaluating corporate financial policy and shareholder value creation. These actions reflect management decisions regarding capital allocation, growth opportunities, financing strategy, and investor relations. Analysts integrate distribution policy analysis with broader assessments of profitability, liquidity, leverage, and competitive position to determine whether shareholder distributions are sustainable and strategically appropriate. The program emphasizes that different distribution methods involve trade-offs related to taxation, signaling effects, and financial flexibility. By understanding how dividends, splits, and repurchases affect financial statements, valuation, and investor behavior, analysts can make more informed investment recommendations and better evaluate long-term corporate financial strategy.